Colgate-Palmolive. You know the name. In fact, I'd bet you have at least one of their products in your bathroom right now. It's a global giant, a company built on routine and stability. But here's the thing. In the world of investing, a famous brand isn't always a fantastic investment. So today, we are going to dive deep, look at the numbers, and answer one really important question. Is this iconic company actually a smart place to put your money at its current price?
And really, this is the question every single investor has to ask. It's so easy to fall in love with an amazing business, right? But the price you pay for that business is what will ultimately determine your return. And that's the exact puzzle we're going to piece together in this explainer. All right, before we can even begin to talk about price, we need to understand what we're actually buying. So first things first, let's break down what makes Colgate-Palmolive tick and why it's such a powerhouse in the consumer goods world. You know, the real beauty of this business is just how simple and predictable it is. Think about it. Toothpaste isn't some luxury item you decide to skip when the budget gets tight. It's a necessity. And that habit, that repeat purchase, day in and day out, creates one of the most stable, reliable business models on the planet. It's a business that's literally built on certainty. And this right here, this is what investors call a competitive moat. It's what protects the company. I mean, controlling over 40% of the entire global toothpaste market, that gives them incredible power on store shelves. But what's really fascinating to me is the psychological part. When was the last time you actively shopped for a new toothpaste brand? Most of us just don't. That loyalty, plus their massive size, creates this economic fortress that's just incredibly tough for anyone else to get through. Now, take a look at this number, 36.64%. That's the company's average return on invested capital. So what does that even mean? Well, simply put, for every single dollar Colgate puts back into its business, it spits out almost 37 cents in profit. That is an exceptionally high number, and it proves this company isn't just big, it's an absolute cash-generating machine. Okay, so we've established it's a phenomenal business. But that's only half the story, isn't it? Now we get to the core of our analysis. We have to figure out how the price you pay on the stock market today stacks up against what the company is actually fundamentally worth. Before we jump into the specific numbers, let's make sure we're on the same page with this idea of intrinsic value. This isn't the number you see flashing on your screen every second. Nope, it's an estimate of what the business itself is worth, based on all the cash it's expected to produce for the rest of its life. For a value investor, this is the true north. And here we have it, the central conflict of our entire story. The market, right now, says Colgate-Palmolive is worth $95 a share. But when you do the hard work of digging into the cash flows and the fundamentals, the analysis suggests the business is really worth something closer to $75 a share. That's a huge gap between the price and the actual value. This table here breaks down how we get to that number. We use a couple of different valuation methods, and they both point to a value right there in the mid-70s. But look at that last line, margin of safety, negative. As an investor, you always want a buffer, a discount between what something is worth and what you pay. In this case, there's no buffer. You're actually paying a premium. Okay, so any valuation is just a single estimate of the future, right? The future is uncertain. So to get a clearer picture, we need to look at a range of possibilities. What could happen in a best case, a worst case, and a more likely base case scenario. This SWOT analysis just lays the tension out perfectly. On one hand, you have these massive strengths, that incredible brand and its rock-solid cash flows. But on the other hand, you have two really significant weaknesses. The company isn't growing very fast, and as we just saw, its valuation is sky high. Now, this chart models out those different futures. Our base case, the most likely outcome, points to that $75 value. A more pessimistic bear case puts it at $60. But here's the real kicker. Look at the bull case. Even in a super optimistic scenario where things go really well, the value only gets to $90, which is still less than the current market price of $95. So what does this all mean for you, the investor? Let's try flipping the question. Instead of asking what the stock is worth, let's ask, what price would you have to pay today to get a decent return? Let's say a 9% return per year. So you have to ask, why is the stock so expensive? Well, here's the theory. The argument is that in today's uncertain world, investors are desperate for safety. They're treating Colgate stock like it's an ultra-safe government bond. They are paying a huge premium for that feeling of certainty, not for the company's ability to grow in the future. And this table right here just makes the math crystal clear. If your goal is to make 9% a year over the long haul, which is a pretty standard target, you'd need to buy this stock at $68 per share. That is almost 30% below where it's trading today at $95. This just hammers the point home. You might be thinking, well, what if I just hold on for a really long time? But look, even if you plan to hold for 16 years, the price you'd need to pay to get that 9% return doesn't really change. Time in this situation simply doesn't fix the problem of paying too much upfront. All right, we have looked at the business, we've calculated its value, and we figured out what it takes to get a solid return. So, what's the verdict? What should an investor do with Colgate-Palmolive today? The final takeaway here is pretty straightforward. What we have is a fantastic, high-quality company that's being priced as if that quality alone is enough to guarantee a great return. And it just isn't. At $95 a share, the math suggests your returns are probably going to be pretty underwhelming. So the recommendation? If you already own it, it's a hold. But for new investors, it's a watch list candidate. A great business to keep an eye on, hoping for a much, much better price. And that really leaves us with the final thought, doesn't it? For a wonderful business like this one, the real key to making a great investment isn't just about finding the quality company. It's about having the discipline and the patience to wait for the right price. And in a market like this, patience might just be the scarcest commodity of all.